Sen Eng is an international investorpreneur that has an institutional investment background in venture capital, private equity, and family offices. In his early days as an entrepreneur, he raised over $100 million, and he has deployed more than $500 million in capital as an investor. Many of us out there work on syndicating real estate investments, typically focus on attracting high net worth individuals, which could be either accredited or sophisticated investors. There aren't many people in our space that raise capital from institutional investors. I have found those individuals that are able to raise institutional money tend to grow much faster. While our entire conversation is not solely focused on real estate investing, there are some important parallels you can grab onto and apply them to your business. One of those key points that stood out is timing of the exit. When is the right time to exit? Join me as we step into the mindset of an institutional investor.
Welcome back to another episode. Today we have Sen Eng joining us. Sen, welcome to the show.
Great to be here, Dion. Thank you.
Glad to have you. So let's tell our listeners a little bit about your background and how you got started in real estate.
Sure. Well, I'm a Chinese-American aspirational Canadian. I've always done real estate as an appetizer and found myself enjoying it quite a bit, made some money. And so recently, just about a year ago, decided to dedicate the next 10 years or so. I like to look at things in 10-year chunks to making real estate the entree. So previously, I had a background in entrepreneurship, started a bunch of tech and consumer companies, raising quite a bit of money, venture capital, over 100 million. And then after that, I spent about 20 years as a professional investor, starting and running, managing a bunch of venture capital and private equity funds, primarily in Asia, out of Shanghai, not too far from where you are in Beijing.
All right. So as far as your experience with raising capital from the entrepreneur's perspective, you raised over 100 million plus in some of your ventures. Can you take us a little bit, back during that period and kind of walk us through that process? What was that like?
Well, the bulk of the 100 was during the last .com. Probably you're too young to have experienced that, Dion, but that was the initial .com boom. For a venture that I co-founded, I was initially the CFO, but eventually became the CEO. We were doing internet telephony services, which obviously some of the technology behind Zoom and Skype and all that. And so we ended up raising 60 million plus through a number of rounds, Series A, B, C, D, E, F, towards even a dual NASDAQ Hang Seng listing. So in the venture world, in sort of the fast-moving technology venture-backed world, it's almost a nonstop fundraising. You're burning, you're growing for market share at the time, and a lot of companies as of today. So the process becomes very systematic and institutionalized, right? So yeah, it's a full-time job for both the CEO and the CFO.
So this raising experience and that you had, like, how did you go about, because it was a new venture, right? So how do you go about finding and identifying these types of investors that are willing to bankroll these at the time?
It's an interesting question. I think it's same as finding investors for any asset class, whether it's real estate or tech. The thing to remember is when you're raising money from institutions as opposed to, let's say, a W-2 or high net worth individual, the institutions are typically management professionals, and their job is to invest, right? They have to invest. If the fund manager does not invest, they don't make returns, they lose their jobs, and they don't make money. So depending on what asset class you're the entrepreneur behind and what kind of money you're raising, if you figure out what their strategies are, what their likes are, and you figure out what the checklist is in terms of what they're looking for, it actually is, in my view, easier to raise larger chunks than to raise, let's say, 50,000 from a unsophisticated or less sophisticated individual. So in this case, obviously, we were in the fast-growing technology.com space, and we raised a lot of money. I would say split in Silicon Valley venture funds, as well as some on the Asia or China side. That I mean, again, their jobs is to find the next big thing, and so you have to position yourself as such.
What kind of returns are institutional investors looking for typically?
So I always say, if you read the prospectus of a venture capital or private equity fund, I'm more familiar in the early stage tech side. Almost all of them promise on the 10-year fund 25% IRR, which obviously is a high hurdle. If you look at the reports, there's a company called Preqin that looks at the returns of global private equity venture capital funds. Typically the top quartile, I haven't seen the latest report, the top quartile of the GPs, the managers, might hit the 20-25% plus. These are the Sequoias, these are the Capital Todays of the world. And so it's just like picking a stock. If you find the right manager, you will make massive returns. But the majority actually don't hit those returns. And there's a challenge. If you're a family office trying to invest in the Sequoias of the world, or the top 10, 20%, unless you're a major player with big pockets, they have minimums and they don't actually need your money. So it's very dog eat dog, right? Yeah.
Well, regarding the actual pitch, right? How do you find that pitch differs when you're pitching an institutional investor versus a high net worth individual?
So I don't actually have that much experience pitching high net worths. We had out of our fund one, which is 100 million, it was primarily taken up by family offices. We had a couple of Chinese government entities coming in. We had two, I can't name them, but we have two of the largest European family offices, names you would recognize. We had a huge Korean conglomerate, and they made up, I'd say, 80-85% of our fund one. And then once the institutions came in, then you got some friends and family. We had a couple of .com internet entrepreneurs that have done really well. These are friends, poker buddies that we trust, and they'll come in for $1 million, $2 million. But typically, once you've got the larger ones in, the $1 million, $2 million don't matter as much. Yeah. So it wasn't they had the same placement memo, and typically their process is a lot less systematic, and the angels tend to sort of know you already, and they may be following what the institutional guys do. So having a major institutional or a few of them follow you makes it much easier to get the smaller guys.
So regarding the actual type of fund, like when we're looking at like a blind pool versus a pledged pool, especially for investors out there, which do you think is more suitable for our industry and what we're doing?
Multifamily?
Yes.
I think, there's so much activity in what you're doing and what my friends are doing in raising $1 million, $5 million for a syndication project. I feel like the amount of work being done, setting up OMs, webinars, legal, is, I wouldn't say it's as much, but it's materially significant. So I think from efficiency standpoint, if it's possible for the sponsors, the team to raise a blind pool, then obviously you're more efficient. And the capital is captive, right? As opposed to an as needed basis. So, it makes more sense, if possible, to go to blind pool.
But with the blind pool, one thing would be you'd have to be ready pretty much to deploy it quite quickly, right? If you're raising a blind pool, otherwise you're going to have to pay interest on the money, or how would that work?
Oh, no, that's There are many structures, but a typical 2 and 20 blind structure where there's a venture capital, private equity, and I think for real estate is let's say you raise $100 million blind pool fund, the typical capital call is initially 20%. Again, you could adjust it. You could call more if you have a warehousing of deals lined up. And typically you have a 3-year investment period. And so the money, the 20% you would probably then be able to deploy in the first year. And then as you find more deals, you call the capital, and the investors, the LPs, are committed for the 80%. But typically it's called within three years. Sometimes it's extended, and you've got a few more years to sort of manage portfolio and eventually exit. So the typical fund is a 10-year life. It could be 7 years depending on what structure. Some funds are evergreen, the way you redeploy the capital. But to answer your question, because it's a capital call, the IRR does not start clicking on 100% of the capital. IRR only ticks when the capital is called and then eventually deployed. So it's a fairly simple but logical structure.
Okay. Yeah, that makes more sense then. You've invested in a lot of different projects, and not all of them, real estate related. One that I saw was you were invested in a 3,000 store snack retailer, also a boarding school. I think had 2,000 student capacity boarding school, right? Can you tell us a little bit more about those projects?
Yeah. So that's from my fund one, where we focused on early growth companies, and so this is post revenues, typically with EBITDA. It might have been founder funded. It might have been around for 5-10 years, but they have a product, they have revenues, they eventually actually might be profitable. And so this is a China fund, and we focus on technology and consumer. So out of the consumer bucket, we invested in a number of real estate linked deals, so including a major boarding school chain brand. Again, I don't want to say, but it's a super famous British boarding school that we brought to China, which because of the branding and the demand for international education, we were able to get a super sweet land deal. Essentially, the land was free for 40 years, and the government actually built 6 buildings for us. Essentially, they built an airplane, CapEx, and we just used it. And so it was very easy to be profitable because the rest of it, the desk, the chalkboard, the teachers are variable costs or very minor CapEx. So that was one project. We also did a number of retail link projects that were at least 1,000 doors. There was a fashion chain that had 3,000 stores, including franchisees. You would know the brand being in China. We invested in a snacks chain, which at the time became the largest chain of little kiosk snack chains in China. We sold that to Morgan Stanley's fund 3 years later. So those are really, and then we did a Chengdu-based cosmetic surgery chain, which is obviously linked to clinics and hospitals.
So, I mean, that's quite a successful track record that you have there. So what do you think was like one of the main keys for you in, having so many successful exits like you've had so far?
To be honest, I mean, everything is relative. Again, I have, as you know, I'm trying to finish a book about investing. And last week we interviewed Kathy Xu from Capital Today. You probably know of her. She's the #1 woman in the Forbes medalist in China. #2 globally after Mary Meeker. So relative to superstars like her, my returns are quite modest. And I am spending quite a bit of time studying people that have been much more successful, people like Kathy. This week we're interviewing John Ruffalo, who is a top Canadian VC, to try to figure out what are the secrets that the masters like the Buffetts and Dalios invest. But I think in general, I think, what I'm hearing and what I'm learning is obviously picking the right macro. So a lot of times managers or investors, especially men, think they're smarter than the market. What I've seen studies that actually stock picking is often only 30% of the profits. A lot of it's being the right market, sort of a rising tide situation. So really finding the right macro. If you're in a super rising tide, let's say China in the early dot-com days, you could be an average investor in that space and still do really well. You could pick the best stock in a declining industry and still lose money, right? So I think maybe taking some of the ego out of it and picking the right space.
Mm-hmm.
Again, the book that I'm writing, it's called Investor's Bible, and it's the subtitle is the 10 Commandments of the Investment Gods. And so by studying hundreds and hundreds of smart investors, and also obviously looking at my own mistakes, and I'm trying to figure out what are the 10 commandments, so the guiding principles to make success. And as a sneak preview, the other one that I think Kathy mentioned that I really am learning myself is don't sell your winners. So John Lay from Hill House, bet early in Tencent, he held on to it. Buffett's famous investment in See's Candy, he held on to it. Kathy's holding on to JD.com. I'm a lover of Elon Musk and Tesla. I didn't sell it at 1,000. I'm going to keep those. I think early on, I tended to take profits too early. Apple, case in point, right? At $1 trillion market cap, people were selling. I sold it. It's now 1.5 trillion. So we're trying to put together these lessons. By no means am I done with it. Hopefully, by the end of the summer, we'll have an amazing 10 commandments to share with you, Dion.
Mm-hmm. Yeah, I'm looking forward to that. Actually, you reminded me of a guy I used to work with, a gentleman. He had a private equity search fund in Boston. I was an analyst on his team. And I remember it was several years back, and we were looking at Facebook, and he's like, yeah, can you give me a price on Facebook? What do you think? And I think it was trading at like $90 some at the time. And I did like a DCF analysis on it, and I put a price around like 150, and I was like, yeah, I really think it is. And I put forth a really strong case for that. Needless to say, it increased, I think, like about $10-15, and then he decided to exit. And then it was like 2 months later, he was like, yeah, I did the dumbest thing ever, you won't believe. I was like, let me guess, is it Facebook?
Yeah, it's interesting. I think my team and I have now finished studying, and some of this is primary. I didn't get a chance to interview Dalio, but there's a lot of stuff on him, Buffett, Munger, Peter Lynch. And then some are primary where we have a chance to speak to John Ruffalo or Kathy Xu. We've done about 50, 55 now. Mm-hmm. And one of the recurring themes is really don't sell too early. If there's not many good assets in the world, mm-hmm. once you find one, unless the thesis changes, especially if they're cash flowing, don't take profits. Let it compound. Mm-hmm. Compounding is magical.
Mm-hmm. Yeah. When you say, don't sell early, I think that a lot of people may tend to ask, well, then what would early be? Like, what is early like? So I guess in your mind, and you may still be developing this thesis here, but in your mind, what do you feel early to be?
I mean, it's tough to say, and who knows this, right? And obviously, you should have a disclaimer. This, I'm not an investment advisor, a lawyer, or whatnot. So this is just all our conversation between friends, right, Dion?
Yeah.
But again, I really spending a lot of time. I've owned a Tesla. We'll just talk about EVs in Tesla, and I'm looking at the China version, the Neo. If you've driven a Tesla, and I've driven it for 2 years now, and if you talk to friends that own Teslas, there's just no going back, right? So I think Tesla in the EV market is like 17% market share, but in the overall market, it's like low single digits. So if there's a belief that EVs will take over as the future cars, and there's essentially computers where there's growth, if they're less than 5% market share globally, then is 1,000 too high?
Mm.
Is 1,000? 1,000 might be too high given the current net income or cash flows from Tesla, but I don't see anybody even close to Tesla in terms of what they can do, in terms of the battery, in terms of the charging stations, in terms of all the other vehicles that are coming out, right? Cybertruck and others. So maybe today 1,000 is too high. Maybe it'll drop to 500. But if they continue to capture 10% market share, would the shares be worth 3,000? Absolutely, right?
Mm-hmm.
So I think for me, it's really less the day to day than more thinking, okay, I have a thesis that, the EVs and the autonomous driving that's building, all that is going to eventually take over the world. And globally, Tesla is the winner. Now, my other theory is Tesla is doing well in China, as you know, but it's a foreign company. And there's no way that the largest EV market in the world, China, is going to let a foreign company take all the market share. So then the question is, if China is the largest EV market in the world and there has to be a local player, then the thesis is, well, who's that going to be? There's not that many. There's Xiaopeng, there's NIO, there's BYD. There's really not that many right there. So right now I'm trying to think through which is going to be the China player. You're there. You let me know.
Yeah.
And eventually, there will be a Chinese player that will take over the world with EV. So to me, I it's really less the day-to-day valuation. And I wish I had followed this advice, which is really not mine. This is really advice that I'm getting as, again, ride a 10-bagger, I think, or hold, not sell exceptional companies. That's really one of the 10 commandments that I'm arriving at. And it's compelling me to trade less and really think through a conviction on an investment. And as long as the thesis hasn't changed, right?
Yeah.
Why sell it? Why sell it?
Yeah, I mean, Tesla. You're absolutely right here. When I think about it, especially being in mainland China for so long, I mean, Tesla it's kind of like, the class A, if you will, when it comes to EVs in China. Like a lot of people here, if they're looking at EVs, they want a Tesla. They typically don't want some of these other, like BYD and Beidai and whatnot. And I mean, I guess just from an overall design perspective, performance perspective, Tesla is just really on top. I just saw something too in the news recently, something about the Tesla battery can last for quite a long time. I can't remember what it was. I didn't actually look at the details. Do you know anything about that?
A million mile. Yeah, it's a million mile. Yeah. Yes, it's so, I blog occasionally too, and I was actually talking to my kids about Tesla reminds me of the next Apple, and then the next day, Morgan Stanley published a report saying Tesla is the next Apple. I'm like, damn, I should have done this last week, and then it would have looked smarter. Now it looks like I would be copying Morgan Stanley, but I completely agree. Tesla, like Apple, makes an amazing product hardware that, like the iPhone, just drives people crazy. You see these fanboys. I'm a total iOS fanboy. The AirPod, iPad, everything. And then once you sit in the Tesla, everything they built is just super crazy. But like Apple, I see this not as a pure hardware play. I see this as a platform services play. Think about it. In my Tesla, we have 2 drivers. It has my profile. It knows how I drive versus the next driver, because each driver has a different profile. And it knows how long I drive, where I drive to. It knows my age. And Tesla will eventually launch, just as an example, insurance. They'll just sell insurance to me. And they can underwrite my insurance much more accurately than the traditional insurance company that doesn't know anything about me, right? And offer it direct to me at a cheaper price, but still have less losses because they know so much about me, right? That itself is a massive market. Let's not even talk about, anything, right? So there's all the services that are coming along that will make this so that the energy transport, again, for lack of a better product, I actually think it's going to be bigger than Apple, but essentially it's a similar model to me. They've got both the hardware, they've got a vertical integration, and they got a genius running it. Yeah. Anyway, is this multifamily or is this technology investment?
Yeah, I know. Yeah, I know. Oh, I love it though. I love it. I love, hearing about these things and talking about it because, I've gotten a lot into technology a little bit lately too. I think especially after living in China for so long. I mean, I swear this has got to be, the up and coming tech capital of the world, if you will. You see just so many interesting tech, that's out here is being used by people nowadays. So, but, it's quite interesting because, I mean, you're into technology and you've done all these other businesses. So why did you end up choosing multifamily?
Yeah, thank you. I actually think this is an important question. So I don't run a fund now. I left China because of my kids are going to school in North America now, and so I walked away from that platform, which is a huge, I would say, sacrifice. But I think it's worth it. Right, just taking some time off. So I don't really I don't have a fund now. I'm just investing family and friends, primarily family money. And I looked at a lot of different things. And so for me, for my own money, I'm putting or allocating a majority of my own available capital to multifamily. I'm still dabbling here and there in investings in both the private side. Last year, I invested in a insect business just for fun, but we talk more about that. But obviously, also investing in strong conviction stocks like Tesla. But the majority of my time is investing passively in multifamily, but also actively in multifamily. And I just think that at this point in my life, because I'm looking for money to grow my wealth and cash flows without having the hassle or to having works, because when you run a fund, it's actually so much work, right? It's not as easy as it sounds. You're chasing other funds and you're bidding for other deals. So for me, investing in a stabilized asset class, let's say like a 50, 100 door multifamily, where I'm getting 8, 9, 10, sometimes 12% cash on cash, compounded year after year, is obviously amazing because it's almost a guarantee if you pick the right asset. Versus, let's say you put it in the stock market, which is volatile. Long term, you get 8% in the US, 7% in Canada. It's still less than that, right? That 2% difference is actually quite different. And obviously, if you pick the right market, I was in Tampa for a month. If you're in a Florida or Texas market where it has above average national growth in the States, you might have between organic appreciation of the MSA plus force appreciation, another 5 or 10% growth in valuation, then you're actually doing quite well. And without the hassle of sitting on a board seat. For my fund, I was sitting at 9 board seats with 9 super smart, egotistical CEOs, and trying to manage them was a lot of fun, but it's also a lot of work. In an asset, if you bought it stabilized, you've got both the appreciation angle as well as the cash flow angle. So for me, that's why I'm spending a bit more time. I will continue to do this in the short term until I build a sufficient portfolio, because I'm still fairly new to this, of both passive and active. And then, maybe if I'm sitting on 1,000 doors or a couple of $1,000 one day, I will then switch a bit more time to the riskier projects like technology. More time for that. So does that make sense? Yeah.
Yeah. That makes perfect sense. Now, with these multifamily properties or investments that you're looking at, especially on the active side, are you looking at these as just kind of like really long-term plays, like kind of the generational wealth? I'm just going to sit on these, they're mine. Or are you still looking at kind of like that 5, maybe even 7-year exit now at this point because of COVID?
Yeah. So Dion, I'm not that experienced in especially North American real estate like you and some of the other speakers. Again, I decided to turn majority time, and never full time, into multifamily less than a year ago when I turned 50. I'm turning 51 next week. So it's really less than a year. And in the past year with my brother in New Jersey, we bought, not syndication, we just bought ourselves using the BRRRR strategy. Maybe we together own about 50 doors of 2 to 6 families. That was great fun learning from him. He's got 20 years doing that, never lost money. Because in BRRRR, you refi all the money back out. Essentially, your equity IRR is infinite, right?
Mm-hmm. Yeah.
In 6, but that model.
Yeah.
I love what he did. I love the numbers on it. However, it's a lot of work in terms of the smaller ones. He is super experienced GC. He's an engineer. He has a modular home license. He's a licensed broker. So he loves hands-on stuff. I did it for him. I learned from him, but I felt like that's really not me. So I started investing passively in larger multifamilies, and found that, hey, this is really interesting. As a passive, if I'm getting or 8% preferred, maybe 50% IRR. I'm getting 1.5 to 2 times the money over 5 years. What can I do if I'm active? So I recently started to look at active in the larger 60 plus. We are actually making an offer for 130 unit this week in the Central Florida market. I hope we can close that. But we'll close one in the next couple of months. And those obviously you make a bit more if you're active. So I think it's fun. It's fun. And then with the larger ones, you could obviously afford a property manager. So you're active, but you're really not as active as a smaller, five door bird strategy.
Mm-hmm. Now, you mentioned that you spent the last month in Tampa, and I'm assuming you were looking at deals down there. So what were some of the challenges that you've seen in that market with some of the properties that you were looking at?
It's always valuation.
Mm.
All right. I actually looked at small ones as well as, anything from 10 doors to 300 doors, just to kind of get a feel for the market. And I would say across the board, pricing hasn't reflected potential recession, depression. And then some of the good assets have been pulled from the market. So it's really pricing. I think in the past month, I made 4 offers. This week will be the 5th offer. Of the 4, 2 are back and forth, and I'm probably within 5-8% striking range. Mm-hmm. So I'm hopeful, one of these will eventually hit. That still does not violate, I think, fairly conservative underwriting assumptions that we have. Yeah. With
those the properties that you're looking at that you do have the offers out on, because you just mentioned the pricing, right? What kind of returns are you targeting for those?
Yeah. So I have an offer up to a 16 unit that probably I won't syndicate. It would just be some friends and family. 16 unit, I think, I'm at 1.7, the owner is 1.78. We'll land somewhere between 1.73, 1.75 million. It qualifies for an agency loan. The product is in the top area, historic Old Northeast in St. Pete. It's a beautiful, beautiful area. It's a beautiful building that I would probably keep forever for my grandkids. Using fairly conservative, I'm looking at a high 9 cash on cash. And depending on the reversion cap, if I use a 7.5 reversion cap 5 years sale later, it's close to a doubling in terms of value. Mm. For the passive, not even for me, just for the passive. But in this case, we're probably not syndicating. The 130 unit, it's asking 17.75. We're probably going to offer 16.5 and land somewhere between 16.5 and 17. I've got 2 partners in there that are quite experienced in multifamily. That one, it's actually quite similar. For a passive, we're looking at it probably a high 9, low 10 cash on cash, and a 80 to 100% 5-year return. Mm-hmm. So the cash on cash plus the disposal, the exit value, depending on what kind of reversion cap and other assumptions we use. So at a 17 million assumption, the highest we would pay, we're getting those numbers. Mm-hmm. The trick right now is somebody might come in and offer a higher price.
Yeah. So are you guys, you mentioned that you're being a little bit more conservative on the underwriting then. So probably not projecting much rent growth at all within like the next year or 2 or?
Yeah, I think in all of our underwriting, we're assuming rental is like 3%, right? Essentially growth rate, which is quite low for historical Florida and Tampa. But our expenses are growing 2%. So it's net, we're growing 1% growth, right? Mm-hmm. So there's almost no growth. And then for properties where we are rehabbing, for both of these, the 16 unit and the 130 units, we're assuming like first year economic vacancy as high as 23%, 25%.
Wow.
Right. And even year 3, we're assuming 10% economic vacancy in anticipation of potential recession to still get the 9%.
Wow.
Cash on cash 10%. Yeah. So we're pretty tight. Mm-hmm. which is why I don't have a deal yet, but we will.
Yeah. So what would you say to new people that are looking at getting started?
In multifamily?
Yeah.
Oh, well, that's me. I'm pretty new. I mean, prior to last year, I had only I exited a 20 unit in the island of Saipan. I'm not sure if you know where that is. It's close by, closer to you than it's closer to me. That was the largest deal I did. And I did maybe 24 single families. So I actually don't have that much experience. I think it's fun. It's actually, I don't want to say it's easy, but compared to try to flesh out why Tesla makes sense, why investing in Insects makes sense, or why investing in JD.com makes sense, this is just an asset class with cash flows, right? It actually is not rocket science. So my 17-year-old who has an interest in real estate, I'm proud of this, actually is one of my partners in this. She's helping me do the research. And her goal for this summer is to close her first multifamily deal with me. Now, I don't mean I do the work. I mean, she does the work too. So I think we'll get it done. We'll get it done. It may be a smaller one, two to three door. So if she can do it, I think certainly your listeners that are much smarter than me, much more experienced than us can do it. So, yeah.
Now, if you can, just one more time, just let our listeners know about your book that's coming out, the name, and where they would be able to find it.
Oh, thank you. Yeah. So the book is called The Investor's Bible. Again, currently the subtitle is The 10 Commandments of the Investment Gods. So if you think about it, in college, you guys all use Cliff Notes, right? Well, so imagine we spent the last 10 years studying all the crazy best investor gods. We created actually 2-page Cliff Notes on these, but then we try to say, what's the theme, right? How does a hedge fund guy like George Soros or Paul Tudor Jones make money versus a Cathy or Buffett? What do they all have in common? And essentially, we're trying to distill this into the 10 commandments. I wouldn't say it's investment rules. It's almost like the real 10 commandments of the Bible. It's almost like guiding principles to make you successful as an investor, not a trader. And so we have a great publisher, Morgan James Publishing, and they've advised us to put up a website. So we put up a website called wizards.institute. And that website is really meant to teach smart investing. It's where we have a community of sharing there. So go to wizards.institute. You can find out about the book. You can sign on for the events. And hopefully you'll join us and participate.
And how could our listeners get in touch with you if they wanted to reach out?
I think there is an info sheet at Wizards.Institute. My company that does real estate is called Sky Tian Capital. Sky is Sky. Tian, as you know, is in Chinese for sky. So it's skytiancapital.com. There's also an email in there for me as well. That's primarily for the investing business. Yeah.
All right. Well, thanks so much, Sen. It was a pleasure having you on here today.
Likewise. It was fun. Thank you, Dion. Hopefully we'll see you when you're back in the States.